The last class, before starting the today's session, we recapitulate the previous class. If you all remember that, we have studied first. We have discussed about what is risk, and then we have discussed something about the risk management process. Under the risk management process, we have seen that there are 4 processes: identification, analysis, and control, and finally monitoring. Then we have seen that those steps, what are the risk management steps and how it's work. Then as a fourth, we just discuss about different type of risk classifications. In the risk classifications, first we have checked the we have seen that there are 2 broader classification. First one is about financial risk, other one is about non-financial risk. In the financial risk, we have seen the credit risk, liquidity risk, and market risk. And non-financial risk, we have seen, we have discussed several risks: operational risk, legal risk, IT risk, strategic risk, etc. So once we seen that non-financial risk, finally we have discussed the cause, events, impact analysis. And basically with this point, we have stopped the class last time. So I'm going to start from that point, and I think there are 7 to 8 slides has to be discussed from the previous class. So first I finish those 8 slides and those matters, and then we will move to the today's session. So if I start that from the continuation of the last session or last class, then we have seen the different type of risk, and we have broadly discussed about the different type of risk. Today we are going to see about different risk management framework. Before discuss about it, is anybody having the any questions you all would you all need to ask from me? Any questions? Okay, since there is no questions, we will move to the today's session. So today's session, today's one, we are going to start from the different risk management framework. The all companies face the risk. Without risk, there is no reward. The last class also we have seen that actually people or the banks and financial institution, when they are doing the business activities, there are inherent risks are available, or various type of risk are involved with that particular investments or business type. And at the same time, when they are facing the risk, there are some when you are facing the risk, there are some returns as well. So actually the companies in the banks and business banks and non-bank finance institution, when they are doing the business in their day-to-day business, they are facing the risk. However, the risk can be managed in the different way, and the risk management allow a balance to be struck between the taking risk and reducing them. Then there are different type of risk management framework. Even though we are saying, okay, risk management involve the 4 steps. The first step is about the identifying the risk, analysis the risk, and then control the risk, then finally monitoring the risk. Even though this risk management having the 4 process, these 4 process can be done in 2 type of the framework. One is the traditional risk management framework, other one is integrated risk management framework. In the traditional risk management framework, it is also called as a silo-based risk management process. If you take a bank as an example, in the silo-based risk management process, each and every division of the bank will manage their risk level separately. For example, we are taking a bank, and there may be credit operations, and there may be branch operations separately. There may be treasury, There may be IT divisions. So all these divisions or department will handle their risk matters or risk aspect separately. It has not been connected as a integrated. That is the traditional way of risk management framework. The risk management, the credit people, they will see what are their credit risk arising from and what are the mitigation they have to take, how to identify the risk. They will manage the silo basis, not the integrated basis, which is called as a traditional risk management framework or silo based risk management framework. But now the banking and financial world move from the traditional or silo-based risk management framework to integrated risk management framework or enterprise risk management framework. Under the enterprise risk management framework, rather than handling the risk management on the silo base, every risk management functions are every division, the risk management functions of the every divisions will be integrated, and there will be a centralized risk management department, and that particular centralized risk management department will take care of the risk management functions of entire banks and financial institutions. For example, if you take a bank, the bank may have, if a bank and that bank, particular bank has the enterprise risk management framework, let's assume that. Then in that particular banks, if they have the enterprise wide risk management framework, and that particular bank will have a separate risk management department or centralized risk management department. And that particular centralized risk management department, they will be responsible, or they are responsible for entire risk management functions of the bank or entire bank. Then actually they will create a different policy, risk policy policy document for the credit management separately, for the treasury management separately, and for the IT management separately, and then they will coordinate with these several departments, and they will manage the risk as a bank as a whole or financial institution as a whole. So this is called enterprise risk management framework. So you can see this in this slide. Enterprise risk management framework, you can see this here. Actually, enterprise risk management framework is the process of planning, organizing, leading, and controlling the activities of the organization in order to minimize the effect of risk on organization capital and earnings. Actually, when we are talking about the risk, actually we have to connect with the rewards. The rewards, in the sense, normally we are connecting with the earnings as well as capital also, because capital, why we are connecting with the capital, in the sense, if there is any excess risk, that will be absorbed by the capital. And then enterprise risk management include financial, strategic, and operational risk, in addition to the risk associated with accidental losses. So that is the enterprise risk management and risk management framework. So as I explained you all, that enterprise risk management framework saying that, okay, the bank as a whole, the centralized risk management department will planning, organizing, leading, and controlling. Or in other words, if we say that the centralized risk management department, with the help of the particular branch and other divisions, they will identify the risk, they will analyze the risk, they will again manage the risk, and they will control the risk. So they will do, the centralized risk management department will do the sort of coordination part with the relevant department. That is called enterprise risk management department. This is, rather than going silo based, this will be the integrated way the risk management functions will be take place in the particular banks and finance institution. Is anybody wants to ask any questions? Okay, I believe that you all are not asking the questions. There may be two instances. Okay, you all can communicate with me. Can anybody just give the feedback to me? Okay, I think something. Okay, I'll continue my presentation. Then, as a next to the enterprise risk management framework, or as a part of the enterprise risk management framework, there is a new concept in the risk management framework. This is not really new, but from after the 2008 and 9 great global financial crisis, this concept got prominent, got more prominent. And according to this risk management concept, there is a 3 lines of defense in the banks and financial institutions to manage the risk. If you manage the risk, there are 3 layers that will prevent any risk occur to the banks and financial institution. If we take our body, okay, there are several germs can attack our body. So to prevent that, first we are having our clothes that will prevent. Then after that we are having a skin, natural skin, that will prevent any attack coming through the germs and other virus or bacteria or any other items. So after that there are some muscles. So likewise there are different layers which protect the body. Likewise, in a banks and financial institutions, the risk management functions have 3 lines of defense to prevent or to mitigate the risk and prevent or to mitigate any losses incurred to the banks and financial institutions. The first line of defense is called so this diagram explained to you all the first line of defense and second line of defense and third line of defense. The first line of defense, of course, each and every business unit or each and every there divisions of the banks and financial institution will responsible for or will function as a first line of defense in the risk management function. If you take an example, the branches can be a good example for the first line of defense. In the risk management functions, the branch manager and other senior officers of the branch will function as a first line of defense for the risk management functions. So basically, they are responsible for internal control measures. In the banks and financial institutions, there are several internal controls which will applicable in the day-to-day business functions. So these okay, there may be internal control policies, but these first line of defense, that means the branch level people or division level people or different department level people, they are the branch manager, he may be in charge to manage the risk or internal control system at the branch level. So he will function as a first line of defense in the branch level or in the risk management function. Then we will move to the second line of defense. In the second line of defense, I have already mentioned you all, the centralized risk management department will become as a second line of defense for the risk management function. Okay, in the risk management function, first we are saying the first line of defense, the branch level or any treasury or any other divisions of the bank will become the first line of defense. The first line of defense is in charge for the or responsible for the to manage the or to implement the internal control measures in the banks and financial institutions. Okay, they are the first line of defense. Now we can move to the second line of defense. Who are the second line of defense? Generally, the centralized risk management department will function as a second line of defense. Okay, the central, what is their responsibility or their function? Their function is generally create the policies, the relevant risk management, create the relevant risk management policies, or formulate the relevant risk management policies and coordinate the risk management functions of the banks, the different division among the different divisions or branches. They are the people, the second line of defense or centralized risk management department will coordinate the risk management functions. So if anybody asks, this is also sometimes advanced, there was a question that who are the second line of defense in a bank, or who is the second line of defense in a bank? Actually, the answer is centralized risk management department will become the centralized defense or second defense of risk management functions. Actually, in some banks, the risk management and compliance functions are functioning together, but in some banks the risk management functions are separately functioning, and compliance functions are carried out by the separate department. So in that case, the centralized risk management department and centralized compliance department will become the second line of defense. Or generally we can say the answer, generally we can say that the centralized risk management department will become the second line of defense. Then the obvious questions will come. Who is the third line of defense? Actually, the internal auditor will become the third line of defense. First line of defense we have seen, and second line of defense also we have seen. Then third line of defense. The internal auditor will become the third line of defense, because they are the people, or chief internal auditor, he is responsible to give an assurance to the top management of the banks and financial institution. Yes, all the risk management functions are in place, and all the functions are in accordance with the policies and procedure introduced by the boards or board level committees. So they are the person, they are the people, internal audit people, they are the people giving an assurance to the management. Yes, all the risk management functions are in place properly. So they become the third line of defense in the risk management functions. If you see that in the slides, you can see that internal auditors provide the governing body and senior management with comprehensive assurance based on the highest level of independence and objectivity within the organization. And the high level of independence is not available in the second line of defense, but internal audit provides assurance on the effectiveness of the governance, risk management, and internal controls, including the manner in which the first and second line of defense achieve the risk management and control objective. Actually, when you are seeing the independence level, the second line of defense, who is the second line of defense? Generally, the centralized risk management department will become the second line of defense. So compared to the second line of defense, the third line of defense, who is third line of defense? Internal auditors are third line of defense. The third line of defense will have more independence, because the risk management department, centralized risk management department, they have to work with the management to implement the risk. But compared to the first line, the second line will have the defense, will have the more independence. But compared to the second line of defense, the third line of defense, that means the internal auditors, will have more independence in their activities. That's why in the banks, you can see the banking structure of the organization structure of the banks and finance institution. Generally, internal auditors directly reported to the board subcommittee, and they are directly responsible for the board subcommittee, and through the board subcommittee they will they will report to the board of directors. So they are comparably, they are having the more independence. So now you can understand that there are three lines of defense in the risk management function. Who is the first line of defense? the branches are become the first line of defense in the risk management functions. They are responsible for the internal implementation of internal control procedures. Then who will be the second line of defense? The centralized risk management department will become the second line of defense in the risk management functions. Chief Risk Officer, who is the head of centralized risk management department, they are the people responsible for formulating policies and giving overall coordinations on risk management functions of the banks and financial institutions. Then the third one, the internal auditors. Who is the third line of defense? The internal auditors. He will not get involved any internal or risk management functions, but the chief internal auditor or internal audit department, they are the people giving assurance to the top management. It means the board of directors saying that the internal control functions are effective and it is functioning well as policies and procedures suggested by the top management. They are giving an assurance, okay, risk management functions are in place properly in the banks and finance institutions. So in this way, that in three lines of defense are working in a bank or finance institutions. But in the literature, if you see this graph, there is another layer which is called fourth line of defense. This is actually in the three lines of defense, it has not been discussed, but in nowadays people are mentioning the fourth line of defense. Generally, external auditors become the fourth line of defense. External auditors as well as regulators become the fourth line of defense for a bank and finance institution for with respect to risk management functions. So in the external auditors, they will have more independency and they will directly report to the board of directors about their audit opinion. So they become as a fourth line of defense. Now you all can understand, I think, the first line of defense, second line of defense, and third line of defense. And the fourth line of defense, even though it is not that much important, but it is better to knowing that who is the fourth line of defense. Who is the fourth line of defense? External auditors become the fourth line of defense. I think you can have now the clear idea about the three lines of defense in the banks and finance institution. Unfortunately, I think we could not have any interactions between us to ask the questions or whether to get the feedback, whether you all are getting real idea about this. But anyhow, I hope that you all are understanding these three lines of defense. If anybody wants to ask the question, you all can ask the questions. Then now, we have seen the first line, second line, and third line of defense. And so these are the up to this point. Actually, we supposed to discuss last class. The last class slides included these aspects as well. But the last class, actually, I could not cover these last 8 slides. So now we have discussed about it. So I'm again moving to the next section, which is again about the credit risk. In the last class, we have discussed credit risk in a very brief form. What is credit risk? And then we have discussed about what are the segregation of credit risk. It is default risk as well as concentration risk. But we are going to discuss that credit risk somewhat detailed manner, because this is one of the area you are getting questions in the exam paper. Generally, we are having sort of two objectives in our class. First objective is getting knowledge about our on the subject matter. The second objective is passing the exam. Actually, that is most of the people attending the class to pass the exam. But meanwhile, we have to get some idea about the the clear understanding about the subject matter also. So I am again going this credit risk, liquidity risk, and market risk part in more detailed manner. So last class we have seen what is the credit risk can be divided into two. One is the default risk. What is default risk? It is a chance that companies or individuals will be unable to make the required payment on their debt obligations. Okay, the customer is X, come and ask the bank to give 50 million rupees. Then bank give, okay, give the 50 million rupees. You have to pay in the 12 installment within 1 week, 1 year period. Every month you have to pay the pay the money back with the interest. That is the agreement between the bank and customer. In that circumstances, if the customer, it can be a bank, it can be an individual, or it can be a company, that customer will be unable to make the required payment on their debt obligations. So in that example, we can see that, okay, we say that there's no interest, there's a 60 million if he get it, then 12 months, then every month he has to pay 5 million as a installment, capital repayment. But if after 3 payments or 4 payments, if the customer does not have ability or unable to make the 5 million payment to the next month, then that will consider it as a default. But default risk is the chance. That is the issue. You have to consider that if it is something happened, it take place. It's already took place, but that is not risk. Actually, I just last class we have discussed that the risk is something uncertainty. Uncertainty should be there. So that's what we are saying. It is a chance that the company or individuals will be unable to make the required payment on their debt obligation. That is considered as a default risk. When we are talking about the default risk, there is a term called default premium is coming into the scene. Before discuss about the default premium, we can discuss something else. Okay, a big company of Sri Lanka, JKH, we say JKH. Okay, the JKH approach a bank to get 100 million rupee as a loan. Same time, there is an individual call 1X, okay, individual X, or some small company X, small company, it is also approaching the same bank to get 100 million to do the business. So are you all thinking the interest rate will be same for the both customer? It means the prime customer JKH and the small customer X. Certainly no, because the bank will feel that there's a less chance to the larger company to default, because it's a highly rated company. It has listed in the stock market. It has a lot of business activities. For 100 man, it has more capital. So 100 million is very defaulting. 100 million is very less chance to the bigger company. But if it is an individual X, it is high risk to the giving 100 million to the individual X, because his capital is very less and he does not have much their business network, and he is not a known person, so a small company, so their risk is high. So what will happen is the bank will offer very less interest rate to the best company and higher interest rate to the small company X. So That is called, the difference between the two rates can be called as a default premium. When you are, those who are working in the banks and finance institutions can be can be understand, or even you, if you are log into the CBSL website also, you can identify the interest rate can be, or lending rate are divided into two rates. Generally, when we are talking about the interest rate, there are two rates, two type of lending rates are considered. One is prime lending rate. In the central bank's weekly economic indicators, you can see that the prime lending rates of the banks and finance institutions, generally they publish the commercial banks prime lending rates, POC, People's Commercial, HNB and all the commercial banks prime lending rates, which is they are offering to the prime customers, where default premium is very less, because they say that they are prime customers, they will meet the debt or their repayment obligations. But that is prime lending rate. Other rate is general lending rate. The general lending rate is definitely higher than the prime lending rate. The difference between the general lending rate and the prime lending rate will be the default premium. If you see that, if we go to the bank and ask some personal loan, they will give say 13%, 13.5, now maybe 12% level. But if a prime customer, some larger company go and ask the loans, they will offer 9% interest rate or 8.5% interest rate. The difference between the 8.9% and 12% will be called as a default premium. I think you all may, and now you all can have an understanding about it. So it is the additional amount a borrower must pay to compensate a lender for assuming default risk. So that is called as a default premium. And so now we have understand what is default risk, and we have understand about the default premium, and estimating the default risk is other matter. Because when you are always, first we have to identify what is the risk, then other one is we have to analyze the risk, or we have to estimate the default risk. Default risk could be identified through the rating reports. How can we identify through the rating report? If it is a highly rated company, say AAA company, then if it is a triple B company or B minus company, then through that rating also we can identify where the default risk will be high. The obviously AAA rate company, there is a less chance to default. But if it is a triple B company or B minus company, definitely there's a high chance to default. So through the rating report, we can identify or we can estimate what is the size of the default risk, or what is the chance of the default risk. And track record. Track record is the most important thing that our Sri Lankan banks following. If a customer, that customer's past records or the CRIP, you all may understand, you all may aware about the CRIP. You all may aware about the CRIP, and the CRIP people generally CRIP people, the Credit Information Bureau, that will show sort of track record. If the particular customer defaulted previously, it will show that okay, that customer has sort of risky. So the track record also one of the indicator we can estimate the default risk. And cash flow statement of the company. Cash flow statement also one of the indication, it will show that if there is a lot of shortage in the cash flow, if there is an excess cash flow for the company, then we can identify, okay, what would be the, if it is the excess cash flow, there's a less chance of default risk. Oh, but there is a shortage of cash flow, then we know that there will be a chance to default risk. So that is an performance of similar interest rate. That is also one of the indicator. You can see that, for example, these days there's a high risk to granting loans to the tourism industry, because tourism industry are totally affected by this COVID-19. So in that similar industry, if one person coming from that particular industry, and then we can have a we can analyze the or estimate the default risk. So likewise, the reporting rating reports, track records, cash flow statement, performance of similar industries will show that there's an estimation of default risk process. Then in the regulators or banks, they are calculating the default risk based on the NPL ratio. What is NPL ratio? It is called as a non-performing loans ratio. In the non-performing loan ratio is calculating the non-performing loans and advances divided by total loans and advances and multiply by the 100. They show it as a in the ratio wise. So actually the 100 is not there in the slides. You can note it out. The non-performing loans are divided by the total loans and advances and multiply by the 100. Then it will give the ratio, the percentage that is called as a NPL ratio. In the slides, you can observe that I have mentioned a word cross NPL ratio. So what is cross NPL ratio? Actually, the NPL ratio, there are two type of NPL ratio. One is gross NPL ratio, other one is net NPL ratio. Actually, you will need not too much aware about, but just for your understanding, I'm saying that before adjusting the provisioning, if we calculate the NPL ratio, that is called as a gross NPL ratio, and net NPL ratio, of course, after adjusting the provisioning, specific provisioning, if we calculate the NPL ratio, that is called as a net NPL ratio. So this is the way generally the banks and regulators and auditors are following way to assess the particular the default risk at a particular time. This is after occurring the default risk. So now we are just discussing about the default risk in the credit risk. And if you all have any, actually, if you all have any issues on asking questions, voice, you all can even text your questions or put into the message box, and then I can just answer the questions if you all have any questions. Then okay, I have mentioned the last class. There are two components in the credit risk. First is default risk component. The second one is concentration risk. What is concentration risk? One minute, there's a question. Yeah, actually the provision, there's a question from one person. Sir, is that the provision is impairment? Actually, provision is, we can't say that it's an impairment. Provision is sort of, sir, can you explain the difference between the gross NPL ratio and net NPL ratio? Okay, I'll go to that questions. Then you can, even the first question you can understand. The gross NPL ratio, normally the NPL ratio, when we are calculating the NPL ratio means the non-performing loan ratio. There's a two-way. First one is the gross NPL ratio, other one is net NPL ratio. Generally, when we are calculating the gross NPL ratio, we are taking the non-performing loans minus interest in suspense. What is interest in suspense? Generally, after the particular loan classified as a non-performing, or if the non-performing, then that even though we record the interest, but that interest actually we will, or the banks may not recover or may not get it from the customer. Those interest, the interest in suspense, that is not realized actually at the point of calculating the accounts or recording the account. So what we are doing is, the gross non-performing loans minus interest in suspense divided by the total loans and advances is called as a gross NPL ratio. The net NPL ratio is the non-performing loans minus interest in suspense minus specific provisions. What is specific provisions? Because as per the regulation, central bank regulations, if the loans classified as a non-performing loans, those who are working in the banks and finance institution may understand, if a loan is outstanding, if the loans are not repaid by the customers for more than 3 months period, those loans we consider as a non-performing loans. There's an arrears for more than 90 days arrears, we consider those loans as a non-performing loans. Then actually, if there's a beyond that period, if it is for, let's say, more than 6 month period, if there is a if the customer doesn't pay the loans, then we will make sort of provision. We will allocate some of the we will make some provision from our profit. Okay, this in future there may be some losses could arise from this particular loan. To secure that losses, we will make some provision amount to secure that value. So in that case, then we are calling as a specific provision. So for the net NPL ratio, when we are calculating net NPL ratio, what we have to do is the non-performing loans minus interest in suspense minus specific provisions divided by the total loans and advances is called net NPL ratio. So now you can understand there are two types of NPL ratio. Even though this is not coming to your questions directly, you can just have an understanding. The gross NPL ratio, net NPL ratio. Gross NPL ratio is the non-performing loans minus interest in suspense divided by the total loans and advances is an exact point of calculation of gross NPL ratio. Net NPL ratio, then non-performing loans minus interest in suspense minus specific provisions divided by total loans and advances. Is anybody knows that, or anybody can say that what is the current NPL ratio in Sri Lanka banking industry? Currently we are having nearly 5%, as a current NPL ratio in the banking industry. Yeah, that is right. One of the students answered that around 5% level. That is the current NPL ratio. So now you will have understand what is the default risk in the credit risk. There are three parts of credit risk. The mainly two section of credit risk. One is default risk. Second one is concentration risk. In the default risk, we have first seen that what is default risk, then default premium and estimating default risk. Under the estimating default risk, somebody asked from me, what is gross NPL ratio and what is net NPL ratio? I think my explanation would sufficient to understand what is gross NPL ratio and what is net NPL ratio. And now we are moving to the concentration risk. This is also one of the segregation or section of the credit risk. And if we see that it is a level of risk in a bank's portfolio arising from concentration to a single counterparty or sector. So what is concentration risk? In any concept, it is better to understand in a simple way, then we can move it to the theory. Okay, what is concentration risk? Okay, we are taking the two examples. The first example is there's a bank A and there's a bank B. Let's take the two banks, Bank A and Bank B. The banks give entire their loans and advances to only to one customer. Okay, but Bank B is doing is they are giving their loans and advances to the 100 customers. In that circumstances, the Bank A's loan is generally highly concentrated to the particular individual or particular company. But Bank B's loan portfolio is well diversified. More than 100 customers receive that loans. Then in that case, what is the concentration risk? If the Bank A, if something happened to the customer where the Bank A granted loans, their India loans and advances, if one customer fail, the Bank A will have severe problem in their risk management functions, or in their, they may have to face more risk. But in the Bank B, of course, there are 100 customers. If 1 or 2 or 3 customers even fail, then the balance 97 customers will repay the loans and advances in the proper way, will meet the repayment in the proper way. Then their loss will be mitigated. That's what we are saying, that this is the concentration risk. If a bank or financial institution grant their loans and advances to a particular customer or particular sector, then that is called as a highly concentration or concentration risk. This is I explain you in the in a customer wise. You can take this as a sector wise as well. For example, again we take the 2 banks, and the Bank A grant most of their loans to the agriculture sector, or most of their loans to the only to the tourism sectors. But Bank B grants the loans and advances, 10% of the loans to the agriculture, 10% of the loans to the tourism, 10% of the loans to the trading activities, and 10% consumption, so on. Then this Bank B is a well diversified, the Bank B has a well diversified loan portfolio. In that circumstances, Bank B have less concentration risk. Why we are saying concentration risk? For example, we are taking the Bank A granting only their entire loan to the agriculture sectors. Okay, let's say assume there's a drought or there's a flood in a particular year. What will happen to the Bank A? Bank A may not get the repayment from their borrowers. Then they will have the high NPL ratio issues, high liquidity risk as well. So that concentration risk create credit risk as well as other liquidity risk to the credit, mainly credit risk to the Bank A, because Bank A highly concentrate to the particular sector, or Bank A highly concentrate to the particular customer. Then there's a concentration risk. That's why we are saying that it is a level of risk in a bank's portfolio. Portfolio means loan portfolio arising from concentration to a single counterparty or sector. The risk arises from the observation that more concentrated portfolio are less diverse, and therefore the return on the underlying assets are more correlated. So this is now, I think you will have understand that what is concentration risk. If you all want any further things, you can send a message. And then when we are saying that concentration risk can be as NPL ratio, the concentration risk also can be measured by an sort of formula, that the loans and advances to a particular sector divide by the total loans and advances. Then we can get the concentration ratio. For example, if the banks grant 15 billion out of their 100 billion portfolio, 15 billion to agriculture sector, then we can calculate the concentration ratio for the agriculture sector. Obviously, what is the ratio? It is 15%, because 50 billion out of 100 billion total loans and advances. So in that way, we can calculate the concentration risk. How can we mitigate the concentration risk? The concentration risk could be mitigated through the diversification. As I explained to you already, the Bank B diversify their portfolio among the customers as well as among the different sectors. I explained you all may remember that. I said that bank B granted loans 10% to the agriculture, balance 10%, other 10% to the trading, other 10% to the tourism, other 10% to the customer. In their portfolio, well diversified portfolio. In that circumstances, this concentration risk for the bank be less. So how can we avoid the concentration? By diversifying their loan portfolio, the bank or financial institution could diversify their concentration risk. Now, if we summarize that, we have first and the credit risk, we say that there are two main segregations. First is default risk, other one is concentration risk. Now I am going to introduce one other part of the credit risk, which is called country risk. The country risk also in some literature, they don't segregate the country literature because they say that it is also part of the concentration risk. But in some literature, in the credit risk literature, mentioning country risk as a separate. So just to have an idea, because if the exam, if they ask the questions, okay, what is country risk, you should able to answer. So that's purpose. I just take into the slide this section to the bring into the discussion. So what is country risk? The risk which arises from a sovereign state when it freezes the payment for foreign currency overnight default, so the obligation which is termed as a sovereign risk. The country risk is exclusively associated with the performance of macroeconomic of a country, and it's also closely related to the political stability of the country. We can easily understand the country risk. For example, time to time, America may impose some sanctions to some countries. Okay, you can't deal with this particular country, or you can't make the transaction with a particular country. In that case, UN may comes. So in that case, we can't transact with a particular country, and that instant circumstances, country risk could arise. And that is one example. Or other example, we can say in 1980s, some Latin American countries, they say that, okay, at one point they just say that we are not in a position to repay the foreign obligations, so meet our foreign obligations. So those who lend to particular Latin American countries face the country risk issue. So that means if a bank or financial institution grant the loans to a particular country, and due to the political reason or macroeconomic reason, the borrower in the particular country could not repay their loans to the particular banks and financial institution, then that becomes the country risk. In our banking industry, if you see that, we have granted some loans to some South Asian countries, especially Maldives and some countries we made. So, okay, if Maldivian government say that you can't repay the loans to outside the country because we don't have the particular reserve or something, then our banks will have the issues. So to mitigate that, what will bank have to do? Bank has to keep a limit to the country risk. Okay, when they are granting loans, they have to keep a certain limit to grant the customers in the particular country. This country risk is mostly relevant to the some global banks. For example, HSBC, Citi, Standard Chartered, like global banks, they may come across these country risk issues. So I think that is the country risk. So we have seen the three segregation, of course, default risk. Then we have seen the concentration risk. Then we move to the country risk. Now I think this is the final, not final, the credit risk, the measures to mitigate the credit risk. So the banks and financial institutions, what are the measures they can take to mitigate the credit risk? What are the measures? First one is carry out the proper credit evaluations. Actually, when they are doing the credit evaluations, if the banks and finance institutions do a proper credit evaluations, the credit risk will not arise, especially default risk. And this is second one is the most of our banks are following, banks and finance institutions obtain valuable collateral. If you obtain valuable collateral, even though if there is a default, we can sell the collateral and get the money. So our banks and finance institutions are more keen to obtain valuable collateral against their loans and advances, which is to mitigate the risk, credit risk. And I say the third one is, I have already explained you enough, to diversify the portfolio. Rather than granting to particular customer or rather than granting to few sectors, diversify the portfolio into several sectors. That will facilitate to mitigate the credit risk, or that is also one of the measures. And the final measures, we can say that making loan loss provisions. Actually, the loan loss provision, we are making the loan loss provisions because as I mentioned already, if the loans are become the non-performing loans, then to mitigate the loss arise from the particular loans, the bank has to make some provisions. Then that will facilitate to make the banks as a to mitigate the credit risk. And then other one is the provision coverage ratio. This is, I think, this section I have already explained to you. The banks are doing some provision coverage ratio provisions, and then the provisions are to mitigate the loan losses arise from the particular credit activity or credit risk. And when they are doing the provisions, there are two type of provisions are required to do. One is general loan loss provision, other one is specific loan loss provision. The general loan loss provision is, if the loan portfolio, they have to do that generally, if they have the their total loan portfolio, they have to make a general provisions. Okay, 1% of total loan portfolio. The 1% of total portfolio. And then you can just or the 2% of particular category of the loan portfolio. They generally doing some provisioning. That is general loan loss provision. Other one is specific loan loss provision. This is a customer wise. Okay, we are seeing that the particular customers' loans and advances. Okay, this is how many days it is in arrears, or how many months it is in arrears, and what are the collateral available for a particular loans and advances. And by considering particular collateral, we are just calculating, okay, what would be the maximum default loss from that particular customer, and based on that particular default loss, calculated default loss, we are just making some provision. It may be 25%, it may be 50%, it may be 100%. Actually, if you will go through the central bank guidelines on credit risk management, you can get to know what are the provisions. There are separate provisions level. So in that type of provisioning is called as a specific provisions. So there are two type of provisions I have mentioned to mitigate: the general provisions, other one is specific provision. In the general provision, of course, it is making the provision generally to the portfolio, or one segregation of the portfolio generally make, not specific loans and advances. But specific loans and advances, of course, they are just particularly consider particular loans and advances and factoring their collateral value and calculating the default, the loss, the given default, and based on that they are calculating the, if they calculate the provision value, that is called specific provision level. In that circumstance, I would like to ask a question from you. I have explained you that the net non-performing loan ratio in the previous slide, I have said that net non-performing NPL ratio, when we are calculating net NPL ratio, we have to calculate the non-performing loans minus interest in suspend minus a loan loss provision. Which loan loss provision? In that circumstances, we have to calculate, we have to consider only specific loan loss provision for the net NPL calculations. Okay, just keep into mind. So specific loan loss provision will be considered at the time of net NPL ratio calculation. Okay, do you have any questions on it? If you have any questions, you can ask. Okay, then I move to the next section. The related party transaction. The related party transaction, of course, this is also one of the important area for the exam purpose, because there are questions repeatedly. So better to understand, and this is also one of the credit risk management related things. The related party transaction is the transactions that take place between the two parties who hold a pre-existing connections or common interest prior to the transactions. Generally, if the banks and finance companies or finance institutions, this related party transaction is most important, because this is the transaction the banks and financial institutions having with their related party. Related party means director, board of director. Okay, bank granted a loan to the one of its director, or bank granted loans to the one of its the spouse of the director or spouse of the CEO. So likewise, if the bank grant the loans to a person who has the connection with a particular bank, which is called as a related party transaction. In many circumstances, we can observe bank grant the loans and advances to the major shareholder. Okay, the shareholder who has the major shareholding in the bank, and then bank grant the loans and advances. That loans and advances is called as a related party transaction. Actually, the accounting standard also required the related party transaction. They also more concerned about the related party transaction. And according to the accounting standard definition, a related party transaction is a transfer of resources, services, and obligations between related parties, regardless of whether a price is charged or not. So the related party transaction is defined as that in the accounting standard. So actually, there are why we are saying we are concerned about the related party transaction, because the related party transaction are generally, I'm not saying always, generally there is a chance to take place preferential treatment. So what is preferential treatment? When we are transact with the related party, the banks and financial institutions give some preference to the particular transaction. For example, a bank grants a loans to one of the director or one of the director's company. Okay, director A, he has a he is a director of the bank, and same time he has his own company in other company, which is a IT related company. Okay, let's assume as a IT related company. So when this bank grant the loan to particular company, what bank can do is bank can give some preferential treatment to particular transaction. What is the preferential treatment? Okay, the similar type of companies, if they grant the loans at a 12% interest rate, they can grant a 10% interest rate. Why they are giving? The director's company. Sometimes for the director's company, since it's a director's own company, they can give the preferential treatment to the particular transaction. Or they can say that, okay, credit evaluation is not necessary since it's a director's own company. We will grant the loans without proper credit evaluations. Or otherwise we can say, since it's a sort of director's company, we need not to get the collateral for the particular customer. We will grant without without collateral, or that means clean basis. There's also preferential treatment. Because why we are saying preferential treatment? If they grant the similar type of loans to other customers, they are getting the collateral. But for the particular company, they are giving without collateral. Or they are doing the proper credit evaluation. After that only they are granting loans to other companies. But for this particular company, they are granting loans without proper evaluations. So that is called as a preferential treatment. Actually, there are some way to identify the preferential treatment. The first way is granting accommodation to related party at a preferential manner. This is the preferential manner that is called as a preferential treatment. For example, we are saying, okay, the central bank announced the 4% interest rate to the SMEs which affected. So just give me the preferential to when the bank can give a preferential to particular director's own company. Because this is a director's company, they can give the preferential manner. That is called as the preferential treatment. Another one is charging lower interest rate for loans and advances. That also I have explained you. The similar other IT companies getting charged 12% interest rate. But for the particular company, we are giving 10%, mainly because this is director's own company. So charging lower interest rate for the particular loans and advances also, we can consider it as a preferential treatment. And paying more interest rate for deposit. Okay, the preferential treatment can happen two ways. One is when we are granting loans and advances also, we can give the preferential treatment. When we are accepting deposit also, we can give the preferential treatment. For example, if the CEO's wife coming with a 10 million rupee or 1 million rupee, she wanted to deposit some deposit with the bank. That time we are giving more interest rate to the particular deposits. So that is also considered as a preferential treatment. Then the providing favorable terms, waiving fees and commissions. Okay, when we are doing some charge, we are charging or banks and finance companies or finance institutions charging some commission and fee. But when we are doing to the particular related party transaction, we are giving favorable terms. And providing service to related party, obtaining service from related party without proper evaluation and procedures. This is also considered as a preferential treatment. For example, the particular example we can take, the director's own IT company, which is a software company. They are providing, they are vendors to provide some software packages. So if bank wants some software packages, they are just purchasing from that particular company without evaluating, without calling quotations, or without evaluating whether the bank can get another good service from other company, without considering that without proper evaluation. They are granting loans, obtaining service from particular company because it's a related party. So these are the type of transaction we identified as a preferential treatment: granting accommodation to related party at a preferential manner, charging lower interest rate for loans and advances, paying more interest for deposit, providing favorable terms and waiving fees and commissions, providing services to related party or obtaining services from related party without proper evaluation or proper procedures could be considered as a preferential treatment. But to avoid that preferential treatment, actually the bank accounting body and regulators are saying that disclosure requirements by the accounting body. Accounting body say that, okay, if there's any related party transaction, if you are having transaction with a related party, you must have disclose it in your annual report to the stakeholders. Okay, whatever, whether it is a preferential treatment or non-preferential treatment or anything, you have to say, okay, I have had a transaction with this much of transaction or this much of services with transaction with particular related party company. Then actually they are defining who are the related party and what are the treatment and all. Actually, we will discuss this later on under the corporate governance sections. And the regulatory requirement, CBL issued guideline on related party, and the SEC also issued the code of best practices related to related party transaction in the corporate governance issues. So I think you all can understand the related party transaction. So now we have seen the credit risk first, and then then we move to the related party transaction. This is also part of related to the credit risk as well, because mostly involved with the loans and advances of the company. Have you all understand? Any questions you all wanted to ask? Okay, I'm moving to the next section, the liquidity risk. This is also we have seen the last time. What is liquidity risk? What is liquidity risk? The banks that does not have, the banks or financial institution does not have adequate liquid assets to meet its obligations. The liquidity risk can be divided into two types of liquidity risk. First one is funding liquidity risk, other one is market liquidity risk. So what is funding liquidity risk? The possibility that a bank would become unable to settle its obligations with immediacy is called funding liquidity risk, because the bank does not have enough funds to meet its obligations. It may be they don't have, or they could not get at the time they required. Actually, the funding liquidity risk is most common in the liquidity risk problem. The bank or finance institution may face this funding liquidity risk in their day-to-day operations. So how can we avoid the funding liquidity risk? The funding liquidity risk could be managed by bank through maintaining the adequate liquid asset ratio or maintaining maturity gap analysis. There are two types. First is maintaining statutory liquid asset ratio. What is statutory liquid asset ratio? Is anybody? You can message me. What is statutory liquid asset ratio with regard to the banks? The statutory liquid asset ratio, in the sense, when a bank raise some, yeah, yes, statutory liquid asset ratio is 20%. That is okay. Before the minimum threshold, I'm just explaining you what is the statutory liquid asset ratio. The central bank issued a direction saying that the banks, especially the commercial banks and even the specialized bank, they must keep the 20% of their assets in the liquid asset format. What is liquid assets? It may be treasury bills, it may be treasury bonds, it may be Sri Lankan development bonds, or it may be cash in hand, or it may be placement with other banks. So those are the liquid assets. They have defined some assets as a liquid assets. In the banks and the banks, particularly banks, must have at least 20% of their assets into the liquid assets form. Why they are saying so? Because if suddenly there is an obligation or depositor comes and asks from the banks for their money, the bank should able to give the monies of the customers, or the bank should able to meet their obligations. So which is called statute. For that purpose, they are keeping that the central bank saying that you must keep 20% at least. For the licensed finance companies, of course, there are different rates. I think for the fixed deposits 10%, and for the savings deposits 15%, for borrowings 10%. There are different cases. So the ultimate idea of this is because the banks and finance institutions must have adequate liquid assets to meet their obligations. So that is one of the mitigation measures the banks having particular stock of liquid assets. Actually, the statutory liquid asset ratio is defined in the Banking Act as well. This is just for your actually this is not related to this study, just for your understanding. Recently the central bank issued a guideline or some directions due to this COVID impact. To avoid the COVID impact, they have relaxed the statutory liquid asset ratio requirements. They have given some approval to the banks. Okay, you can consider some other assets also as a liquid assets. So that is one of the way the central bank managed the liquidity issue in the banking industry, or expected liquidity issue. So that is one of the statutory liquid asset ratio. Other one is maintaining maturity gap analysis. What is maturity gap analysis? Actually, when you are if you are working in the banks and financial institution, particularly in the treasury department, or you may have the understanding about the maturity analysis. Actually, maturity analysis, of course, if you can know if you can see the board, I can just explain you. I think, in the banks and what the banks will do is actually they may have some inflows and outflows in their day-to-day operations. The banks may have the inflows and outflows in their day-to-day operations. For example, banks, okay, within next 7 days, the bank expects that they will receive 100 million from the loans and advances repayment. They just expect that from the loans and advances repayment, they will get 100 million within 7 days. The same times, they expect that for the deposit maturity, due to the deposit maturity, they have to pay 75 million to the customers. They will come and ask their deposits. So in that case, the bank has excess fund of 25 million. Because within we'll just say that okay, they have only two flows. One is inflows from the loans and advances. One is other outflow for the deposit. From the inflow, they are within 7 days they will get the 100 million as an inflow. Same times they get 75 million. They have to give 75 million as an outflow. In that circumstances, this particular bank has the 25 million as a surplus or a surplus cash liquid assets. So these banks will not have liquidity problem. They are having the excess liquidity. Okay, due to some reasons, say let's take the current example. due to the lockdown. The customers could not repay the loans. So these loans are within 7 days, they are having only 80 million, only 60 million as a inflow. But they have to make the 75 million to the depositor. In that circumstances, this bank has to have shortage of 15 billion. They have the liquidity shortage of 15 million. In that circumstances, this particular bank has to find the way, okay, how to fund this 15 million to meet the depositors. They can borrow. For what are the things they can do is, they can borrow from other customers, they can borrow from other banks and finance institutions, or they can, what they can do is, they can give their treasury bill and treasury bonds and get the repo. They can do enter with the repo agreements, or they can raise their interest rate and get some new deposits. Actually, this is one of the, we are saying that the maturity gap analysis. They are inflows, they are just, this is I explained for the one basket, they are just giving the several basket within 7 days, within 30 days, and 1 to 3 months, and then less than 1 year. Likewise, they are just categorized their asset category into different basket based on the maturity, and they will calculate what is the total inflow, what is the total outflow, and whether that we are having the excess liquidity or not. That is the issue. Actually, this is also again one of the questions again and again coming in the exam, that they will ask that bank business is generally raising the short-term fund and giving the loans and advances for a long term. Then there is a mismatch between the assets and liabilities, because their liabilities is very short term and assets is very long term, because assets, loans and advances are considered as assets. So these assets are very long term, and then they have to manage the long term assets with the short term liabilities. So there is a mismatches. So as a liquid asset management, the bank has to maintain this, as I say, this liquidity risk, this calculation. The bank has to calculate this maturity gap analysis, and they have to find, okay, what we have to do is, if there is a shortage, they have to find the way, or if there is a excess, they can lend to other people. So the funding liquidity risk could be managed by the bank through maintaining the minimum statutory liquid assets, or otherwise maintaining the maturity gap analysis in the proper way. Is anybody asked any questions you all wanted to ask from me? Okay, I am moving. So SLAR, statutory liquid asset ratio, requires banks to maintain minimum liquid assets to meet their obligations. The nature of the banking business create maturity mismatches and thus liquidity risk. Actually, this is the questions again and again coming. The questions are this one. The nature of the business create the nature of the banking business itself create maturity mismatches. How can they manage the liquidity risk? So actually, by calculating or maintaining maturity gap analysis, the bank can manage the liquidity risk, or maintaining the statutory liquid asset ratio in a proper way. So that is about the liquidity risk, funding liquidity risk. The second type of liquidity risk is the market liquidity risk. This is not relevant to the particular institution. Actually, this is it's about the market-wise. This is yeah. There's a questions actually. What is the 2% introduced by the? What is 2% introduced by the CBSL? Actually, you will know that is actually not relevant to the SRR. sorry, not relevant to the liquidity risk. This is about the SRR, statutory reserve requirement. When the bank raised the deposits, they, for example, bank raised 100 rupees deposit, they can grant the India 100 rupee to the loans and advances. They have to come and maintain some reserve, statutory reserve with the central bank. Earlier, it was 10%. So if it is the 100 rupee deposits, what bank has to do is bank has to keep 10 rupees with the central bank. Balance 90 rupees only bank can make as a loans and advances. So then actually from 2019 or 2018 latter part onwards, the central bank, to boost the credit growth, central bank time to time reduce the SRR, the statutory reserve requirement purpose, and then they reduce 10% to 8%, 7% level like that. Then it was for the 4% level previous just before this COVID-19. So now with the recent announcement, the central bank reduced that 4% from 4% to again 2%. So actually ultimate motive is then it will boost the loans and advances. If the central bank reduces the SRR, then bank will have more liquidity. Then that also will create a loans and advances. That is one objective. Other objective is when they are reducing the SRR, the banks and financial institution may have more liquidity. Then there is a more market liquidity. Actually, that is also one of the way to boost the market liquidity. So this is relevant to that. So that there are two objectives. One is giving more liquidity to the banks and market. By giving more liquidity to the market will able to grant more loans and advances. That is one thing. And if any banks and financial institution face the liquidity issue, then they can just they can borrow from each other financial institution, because in the market itself there are more liquidity. But here, of course, the market liquidity is, that is one thing. Other one is sometimes banks and financial institutions, even though they have enough liquid asset, they may not able to sell that into the market. For example, in the 2008 and 9, this great financial crisis time, the US banks lost the confidence about each other, on each other. So what they did is they did not lend each other. So what happened is there is no liquidity. Then the interbank market did not take place in proper way. So the bank, even though they had assets, they could not sell it, or they could not borrow it from the interbank market. So and we can say this market liquidity issue actually, even though we are having the liquid assets, we may not able to sell and encash it in the market, maybe due to the illiquid market conditions. For example, if I am having 30-year bond or 20-year bond, and there's a very less chance that to sell that bond into the market. But if I have that 1-year treasury bill or 2-year treasury bond, then there's a high chance to sell that into the market, because that is high liquid for. But if it is a 20 years, 30 years long-term treasury bonds, even it is a treasury bond, there's a less chance, because the market will not accept it because of the illiquid market condition of the thing. So for example, a bank has the debentures, but in Sri Lanka, you'll know that debenture market is very illiquid, very difficult to sell it at the secondary market. So even though they have the debenture, they may not be able to sell it, or if they wanted to sell it, they have to go for a fire sale value. So that will create a loss to the banks and financial institutions. This type of risk could be called as a market liquidity risk. It is an inability to sell or exit from particular investment. For example, if this is actually real estate they gave, but if they have liquid asset, even they can't sell and exit. So what are the measures to mitigate the liquidity risk? Maintaining a minimum liquid assets is one thing. Other one is improve the cash flow projections. Maintaining minimum liquid assets we have already discussed, and improve the cash flow projections, which is also I have explained you all that these maturity mismatches, and then they have to calculate the maturity gap analysis, and they have to improve the cash flow projections, and they have to structure the loans and advances in a way to match with the maturity gap analysis, and perform the stress testing to forecast unusual liquidity requirement. Of course, this is one of the way they can give some shocks, hypothetical shocks to the maturity gap analysis. They can give a hypothetical yeah, they can give a hypothetical shocks to the particular maturity gap basket, and see that whether even that shock the bank could able to survive. Another one is contingency funding arrangement. This is always one of the mitigation factor. If it is a small finance companies or small financial institution, they can have a arrangement with a large bank. Okay, if I am having any problem, liquidity problem for a short term, you have to lend to me at any circumstance. There is a limit, but the particular small banks or finance company may not use that limit always, but they will keep as a contingency purposes. If there's any any urgency, they will ask for money. So those type of contingency funding arrangement they can keep as a mitigation to the liquidity risk. I think there's other two, the maturity mismatch, of course, we have discussed here, and this is other actually this is other questions always coming to the exam. They are asking that what is the difference between the liquidity risk and solvency risk. So before moving that, so what is yeah, what is liquidity risk and solvency risk? What is the difference? Can anybody saying me? What is the difference between the liquidity and solvency? Yeah, the liquidity, as I mentioned, the liquidity is this liquidity is the banks and financial institutions' ability to meet its obligations in the short run. Basically, we can see that the liquidity refers to the ability of a firm to mobilize assets and use them to meet its obligations. This is a short-term concept. Actually, this is the answer for that. What is liquidity risk? The liquidity risk is the ability of the firm to mobilize the assets and use them to meet the obligations. This is a short-term concept. Then what is solvency? The solvency refers to the firm's overall positive net worth and ability to meet the overall financial obligations. It is related to long-term financial position of the bank. Actually, the solvency is a long-term issue. In the long run, the banks have enough assets to meet its all the liabilities or its all obligation in the long run, which is called as a solvency. Actually, solvency is calculated based on the net present value of the total asset should be higher than the net present value of the total liability. The simple way, if there is a net present value of the capital fund one is positive, then that should be the solvency. So that solvency is tested through the net worth or positive net worth value of the banks and finance companies, which is a long-term position of the long-term concept of the banks. It is a difference between the measuring a business ability to use its assets to meet its obligation in short term versus long term. Actually, some of the analysis are saying that this COVID-19 impact on the financial system is starting with the liquidity risk and then moving to the solvency risk. That is what analysts are expecting. It means it may be in the short term, it may be the liquidity risk, but due to this credit crunch and all, in the long term, it will become as a solvency issue. That is the analysis, but the analysis time to time make several predictions. Sometimes sometimes it may come to true, but sometimes it's totally not worthy. So, but now they are just analyzing and saying that the COVID-19 may create the liquidity risk first, and then that will move to the solvency. So basically, for the exam purpose, you may have to have an idea about the difference between the solvency and liquidity risk. Any questions? Okay, then I'll move to the next one. This is our 11 to the liquidity risk. In the liquidity risk, we are having in the banks, those who are working in the banks may know that there's a committee called Asset and Liability Committee. We are just popular name is ALCO. Asset and Liability Committee called as ALCO. ALCO is a decision-making authority responsible for balance sheet planning from the risk return perspective, and also responsible for strategic management of interest rate and liquidity risk. Actually, this is the definition of the ALCO, but you can simply understand the ALCO is the committee responsible for deciding the interest rate of the banks. It means the pricing of asset side and liability side of the bank, and that is the committee responsible for liquidity risk of the banks and financial institutions. So this is basically Asset and Liability Committee, which is managing the asset and liability, and particularly strategically, this is the committee responsible for pricing the assets and liability of the banks, which is the committee basically manage the liquidity risk. And some roles and functions of ALCO is also listed out in the slides. You can read it. The first one is to ensure the efficient implementation of balance sheet management policies. And second one is review the reports of liquidity and market risk management. Normally, other divisions, treasury and other divisions of the bank will give the liquidity and market risk management report. So this committee has to review and get the make appropriate suggestions. And to review the deposit and loan product pricing strategy. As I mentioned, ALCO's one of the main function is pricing the loans and advances as well as deposits, asset side as well as the liability side, and determine the correct assets and liability mix to maximize the profit. This is also one of the function of the ALCO. They have to decide, okay, what is the correct mix? Okay, if it is a long-term loans, 5 years loan, how much we can give, or 1 year loan, how much we can give, and 5 year deposit and 1 year deposit and 3 months deposit. Based on the pricing of the deposits and loans and advances, they will influence and decide the maximum to correct mix to get the maximum profit to the banks and finance institutions, and to ensure the suitable funding arrangement to managing the maturity mismatches, and finally giving direction to manage the interest rates and forex risk. Actually, this slide is it's for the exam. It is always useful to you all. Again and again questions are coming. What is asset ALCO and what is the role and functions of ALCO? You can see the previous past papers. You can get the these questions are again and again coming. So this is about the liquidity risk. So before moving to the liquidity risk, I just summarize it. The liquidity risk could be divided into two. First is funding risk. Other one is the market liquidity risk. And then we have seen the measuring the liquidity mitigate the risk, liquidity risk, and then we just mentioned about the maturity mismatches, and then we have discussed about the liquidity versus solvency. What is the main difference versus liquidity versus solvency? Liquidity is the short-term concept. The solvency is the long-term concept. And then we have seen the ALCO. What is ALCO? And ALCO is responsible for asset and liability management of the bank. Basically, they are the that is the committee deciding the interest rate or pricing of the assets and liability of the banks, and they are the people managing the liquidity risk and forex risk, etc. So they are all this is coming to the exam and again and again, so you will have to keep in mind. And then we'll just move into the market risk. There are market, I think the last week I have discussed about the market risk. Market risk could be interest rate risk, equity risk, and currency risk, commodity risk. Interest rate risk, of course, you all know that the interest rate fluctuations may create a risk to the banks. How can it create the risk to the bank? Because if a bank has the trading portfolio, treasury bill and treasury bonds trading portfolio, the interest rate, what is the relationship between the interest rate and book value, the fair value? There is an inverse relationship between the fair value of the financial assets and the interest rate, or fixed income assets and the interest rate. When the interest rates are going up, the fair value of the financial assets or fixed income assets will go down. And when the interest rates are coming down or yield rates are coming down, fair value of the fixed income assets will go up. So in that way, the interest rate may create a risk, and the interest rate risk is considered as one of the market risk. And equity price risk also, we all know that when banks are investing in the equity market, that equity market price may have an impact to the bank balance sheet. For when the market prices are declining, it will affect the fair value of the equity investment. So that may create a risk to the bank. So that equity price also will have a risk, and it is also called as a market risk. And then the third one is currency risk, currency price fluctuation. So the rupee fluctuation against the foreign currencies, dollar, euro, and yen, will create a exchange rate risk to the country, also to the banks and finance institution, which is also considered as a exchange rate risk or currency risk. Finally, the commodity risk. Commodity risk is, what is the commodity? What is commodity? The gold is one of the commodity. The gold price increase and decline will affect the market. If a bank has the gold as one of the assets, finance one of the assets, then fluctuation of gold prices will affect the commodity. Yeah, one of the students replied that the gold and oil, actually, yeah, it can be considered as a commodity, and those prices also will actually in Sri Lankan banks, not oil prices, but the gold prices have a direct impact on their balance. So the market risk has nearly 4 types of risk: interest rate risk, equity risk, currency risk, and commodity risk. Due to this risk, this commodity, this risk will have an impact to the balance sheet, and that is called as a market risk. How can we mitigate the market risk? It's the same concept: diversify the portfolio. If a bank or financial institution, rather than investing in their assets and liabilities, so the majority of their assets and liability into one particular asset category, they can diversify. Okay, they can invest in something in the treasury bill, something in the long-term treasury bonds, and equity, commodity, and currency. Then even the interest rates are fluctuating, then equity price or currency or through commodity, they can safe. They can earn money, more returns. Or if equity prices are going down, through the interest rate or some other currency risk, currency earnings or commodity prices, through commodity prices, they can earn. So the best way of mitigating the market risk is diversifying the portfolio. Actually, this diversifying the portfolio, we have earlier also discussed as one of the mitigation factor when the sector concentration risk. Actually, and to avoid the concentration risk also, we can use the diversification of loan portfolio. Likewise, here also we can diversify the investment portfolio to mitigate the market risk. Other one is using the hedging strategies. Actually, this is one of the big area. You can just get an idea that the hedge the fund. For example, when they are investing in the derivatives or somewhere, the hedging investing. For example, they are for example in the currency, when they are having the long position on the dollar, they can have a similar short position, then buying and selling at the same amount, then there's a hedging mechanism to mitigate the currency risk. That is also one thing. I think the hedging is one of the biggest area you can learn a lot. So these are the actually market risk I have not much discussed, because the market risk is compared to the liquidity and credit risk, market risk also, even though it's an important, but it's less prominent one. And the exam wise also, the market risk is not that much prominent. The most questions are coming related to the credit risk and liquidity. But anyhow, you will have to study this market risk. So if you can have an idea about these four risk as a market risk and mitigation mechanism, that would fine. Then okay, we can the next concept, we can just move into the risk-based capital. Okay, the banks and financial institutions are we have so far discussed about. Okay, banks and financial institutions have main risk, three type of main risk: credit risk, liquidity risk, and market risk. And why we are studying about the risk? Because the risk could create a financial losses to the banks and financial institutions. To avoid that financial losses, we have to manage the risk in a proper way. Okay, that is one thing. Is the manage the risk in a proper way is the managing the risk is proper way to avoid the losses. That is one way. Okay, if something happened or risk arise, so what would be the safeguard measures? Actually, in the banks and financial institutions, they are saying that the Basel Accord and the international standards are saying that the banks and financial institutions should have more capital to absorb any unexpected losses or losses arise from the risk. That's why they introduce a concept called risk-based capital to the banks and financial institutions, particularly banks and licensed finance companies. It is a method of measuring minimum amount of capital appropriate for financial institution to support its overall business operations in consideration of the size and risk profile. What is the size and risk profile? For example, a bank, which is a very large bank, we say the BOC, and other banks, a very small bank, or very small banks are one of the small bank, and then it is not fair enough to keep the same capital by the large bank and small banks, because their size is different. Other one is the risk profile of the bank also depend on the minimum capital, minimum amount of capital need to be maintained by the particular bank. What is the risk profile? For example, one of the bank A and bank B, let's assume bank A and bank B. This bank A grant the deal with only rated customers, and balance amount they invest in the treasury bills and treasury bonds only, because they are just sort of risk covers strategies they are following. But Bank B, which grant the loans and advances to the agriculture sector, tourism sector, and all sort of sectors, and some risky customers, small customers, SME sectors, they are dealing with the small entities or borrowers. Then Bank B will have more risk profile. Even though, let's assume, both banks are same size banks, Bank B must have more capital compared to the Bank A. Why? Because Bank B deal with highly risky customers, but Bank A deal with the less risky customers, and they are having government securities. So that is why they are saying that based on the bank size, based on the risk profile of the bank, the bank, there should be a mechanism to measuring minimum capital appropriate to the particular finance institution. This is what the Basel Accord saying, that you all may heard about the capital adequacy ratio. The capital adequacy ratio, of course, weighted the assets of the banks and financial institution based on their risk profile. If it is a high risk assets, they are weighted in the high risk, and they are calculating actually how to calculate the capital adequacy ratio and all is out of the syllabus. So we need not to discuss that, but you just get to know that, okay, there's a minimum capital requirement, and based on the minimum capital requirement, capital adequacy ratio is calculated. And the capital adequacy ratio, the concept is based on the risk profile and size of the banks, what is to measuring the minimum capital amount appropriate to the financial institutions. The risk-based capital limit are the amount of risk a company can take. So actually, based on their capital size, their loans and advances are the size of the loans and advances are mainly controlled by the regulators, and it requires a company with a high amount of risk to hold high amount of capital. That's what I say, that the Bank B must have high amount of capital, even though same size bank, because they are dealing with high amount of higher risk customers. And capital provide a cushion to the company against the insolvency. Actually, if there is any unexpected losses or huge losses incurred to the bank due to the any unexpected losses, the capital will provide the cushion. If they actually after 2008 and 9 great financial crisis, only the bank, the world got to know that, okay, there must be huge capitals. Huge in the sense there may be adequate capital to meet the any unexpected losses. So capital provide the cushion. That is, provide the cushion to credit risk. Actually, there's a when we are checking the credit risk and liquidity risk, we are checking, and market risk. Same time, when we are analyzing the bank, we are analyzing whether they are having enough capital, whether they are having enough liquid assets to say to provide as a cushion. So capital and liquid assets are become as a cushion to manage the credit risk, liquidity risk, and market risk. So this is the concept you all must understand. If you all have any questions, you all can ask. Actually, the last two slides, reporting structure and committee responsible for management. This is actually relevant to the some new area. These committees, there are several committees you will have to, and their roles and responsibilities, and how they are get involved in the risk management functions. We can discuss on the next class. So since time is close to the end, if you will have any question, you can ask. Otherwise, we can stop this class today, then we can stop this class and go to the next class if you don't have any questions. Yeah, that's a question called, sir, what is the mean by the interest in suspense? Actually, the interest in suspense is, I have explained you all, when the loans become an arrears for more than 3 months or more than 90 days, that loan is classified as a non-performing loans, because loan portfolio can be classified into two, performing loans and non-performing loans. When the loans become the more than 90 days arrears, then it can be classified as a non-performing loan. Then actually become the non-performing loans arrears, then interest we will not get the interest portion as well. But for the accounting purpose, we will recognize those interest and keep it in the as a interest in suspense. So those interest not realized as a cash flow, but we are we are recording as a interest in suspense. And if there is any calculation, this any performance indicator calculation, we remove the interest in suspense from the total non-performing loans, because when we are acquiring the interest, the unrealized interest, that will increase the non-performing loan. So when we are calculating any performance indicator, we have to remove the interest in suspense from the non-performing loan. That is the concept. I think you all might understand this. Okay, then we will stop this. We'll meet on the next class. Thank you so much.